Now, as you'll recall from your earlier accounting course, liabilities represent the resources that we owe to other parties. In most cases, it's going to be money, but in the case of unearned revenue, we could potentially owe customers goods or services. So our liabilities are presented on the balance sheet, okay? You'll recall that on the balance sheet, we see that our assets equal liabilities plus stockholders' equity. So within liabilities, we divide those into two categories, current liabilities and long-term liabilities. Current liabilities are those that will be paid within 1 year or the company's operating cycle, whichever is longer. As a general rule of thumb, you can just assume that that's 1 year. There's only a handful of companies that will have an operating cycle that exceeds 1 year. So for the most part, we can use 1 year as a rule of thumb when distinguishing between current and long-term liabilities. So current liabilities are those that will be satisfied within 1 year, and long-term liabilities are those that will be satisfied within more than 1 year. Now, we're going to look at quite a few examples together, but here are just some common examples of current liabilities. Current liabilities, we've got accounts payable, sales tax payable, unearned revenues, long-term liabilities, notes, mortgages, bonds are probably some of the best examples. Now, one thing that you're going to notice here is that several of these end in the word payable. That's something that I always emphasize to students. Anytime you see a general ledger account with the word payable in there, you immediately know that you're looking at a liability. Now, that's not to say that all liabilities will end with the word payable, but certainly if the account ends with the word payable, you know that it is a liability. Now, in terms of long-term liabilities, we're going to talk more about those in depth next week. So for our studies this week, we're really going to focus on those current liabilities. And again, those are the ones that are going to be satisfied in 1 year or less. So let's look at some very common examples. Okay, sales tax payable. This is a common example for companies that sell goods to others. They are normally going to be required to collect some sort of sales tax. That is normally going to be determined at the state or local level. Now, as consumers, we're pretty familiar with this. When we buy something, we have to pay the sales tax on it. However, the money that the company is collecting from the customer for that sales tax does not actually belong to the company. That sales tax piece is a liability. As soon as they collect it, they owe that money to the taxing authority. So as soon as that money is collected, it immediately becomes a sales tax payable, and that's what we see here in this example. We're using a sample company called Smart Touch Learning. Here they make a sale for $10,000. They are required to collect 6% sales tax. Therefore, they have to collect an additional $600 from the customer for this sale. As soon as they collect that $600, that immediately becomes a liability. That $600 is not revenue for the company. Okay, unearned revenues. You learned a little bit about unearned revenues in your previous accounting course. Unearned revenue is essentially when we owe a customer a good or service. It's when a customer has paid us in advance of us providing that good or service. So here we see an example. Smart Touch Learning receives $900 in advance on May 21st for a month's worth of work that is going to begin on that date. So at the time that they receive that $900, they have not performed the work. They've not provided any services to the customer. So at the point they receive that $900, they cannot record revenue. If you'll recall back from your previous accounting course, when it comes to revenue and expense recognition, we recognize revenue when we earn it, and we recognize expenses when we incur them. In this case, we have not earned the revenue because we have not done the work. So for that reason, when the customer pays us that initial $900, we are going to debit cash and we are going to credit unearned revenue. That unearned revenue is going to represent a liability account. We owe that customer $900 worth of work. Okay, now we're going to fast forward 10 days in this case when we get to the end of the month. At this point, we have completed a portion of the work. They tell us in this case that we have completed a third of the work. So that means we get to recognize a third of the revenue. So our adjusting entry on May 31st is going to be a debit to the unearned revenue account, debiting the liability account to reduce it, and we're going to credit the revenue account to recognize that $300 in revenue that we have earned. Okay. Another common example of a current liability is going to be a short-term note payable. Now, sometimes students will have difficulty distinguishing between when they have an accounts payable and when they have a notes payable. So I want to take just a moment to kind of explain the difference. Accounts payable are generally going to be the bills that we receive on a day-to-day basis for normal goods and services that we buy over, in the course of our business. So when we buy something and someone sends us a bill for it, that's probably just going to be an accounts payable. The bill's probably going to be due in 30 days, maybe 45 days if we're lucky, but normally it's going to be due in 30 days. And that is a normal accounts payable. A note payable is going to be a more formal agreement. Okay, it's normally an agreement that's going to be signed. It's normally for a longer period of time, so something longer than 45 days, and it has interest associated with it. So that's kind of an easy way to tell the difference when you're working through problems. If it's just a day-to-day bill, it's probably accounts payable. If it's a more formal agreement with a longer time frame and interest associated with it, then it's probably going to be a note payable. Okay, so in this case, they give us an example here. Smart Touch Learning purchases merchandise inventory, and the supplier offers them a note payable. Okay, so they have 90 days to pay this $8,000 note, and it has an interest rate of 10%. Now, here's something that I want to point out because this is very significant. And this is going to be the case not only with notes payable, but just about anything in accounting and finance. When you see an interest rates are always stated at an annual rate. Okay, so that 10% represents what would be the annual rate on that note. So when you first look at that $8,000 note with 10% interest, you may automatically think, oh, okay, so they're going to pay $800 interest. Well, they would pay $800 interest if they held the note for an entire year, okay? But they're not. They're only holding this note for 90 days. So what that means is we have to prorate that 10% interest based on the time period, the percentage of a year in this case, that the company held the note. So to compute the interest expense, we take the principal times the rate times the time. So in this case, it's 90 out of 365 days. And that allows us to compute the interest expense that we are going to owe on the note. Another common example of a current liability is the current portion of long-term debt. Now, we learned earlier that long-term debt is debt that is going to be due in more than 1 year. Okay, so I think it might be easier to understand this if we kind of think about a personal example. So let's pretend that we're looking at a mortgage. Okay, we know that mortgages are normally for somewhere around 30 years. Okay, so that would generally be a long-term liability because it's not going to be paid until 30 years. However, there is a portion that will be paid within the next 12 months because most likely you're required to make monthly installments on that loan. Well, businesses encounter the exact same type of situations where they have installment loans. And it may be a long-term liability, but there is some portion of it that will be paid within the next 12 months. That portion that will be paid within the next year should be categorized as the current portion of long-term debt. Okay, now we're going to learn about another common current liability that most companies encounter, and these are going to be payroll related expenses and liabilities. And we're just going to kind of do a high level overview. Payroll accounting can be a fairly complex subject, and to learn everything about it, we would need certainly more than a week. But we are going to learn some of the very basic and high level things that we need to know from an accounting perspective. In terms of the expenses and the liabilities that we're going to see on the financial statement. So that's going to be our focus. It's going to be very much a financial statement focus. Okay, so let's start by looking at how we determine wages. Okay, this is something that's going to vary from company to company and employee to employee. Sometimes employees may be paid with a salary. Okay, with that salary, they may or may not be eligible for any kind of overtime wages. Normally, if an employee is paid on an hourly basis, they are eligible for overtime. The rate for overtime work is time and a half. So let's look at an example here together. We've got an employee named Ryan who works 42 hours in a given work week. Okay, now his normal rate of pay is $15 per hour. So now we're going to compute Ryan's gross pay for this 42-hour work week. Okay, so for his 40 hours, we're just going to say 40 hours times $15 per hour and gives us the 600. Okay, for his 2 hours of overtime, again, that's time and a half. So we're simply going to multiply his regular rate of $15 times 1.5. That gives us an overtime rate of $22.50. We can then use that rate applied to his 2 overtime hours, and Ryan is going to earn $45 for his overtime pay, giving him a total gross pay of $645. And we would use this exact same calculation for all of our employees based on their wage rate and the number of hours that they work. And again, we may have some employees that are salary where this may not be applicable. That's something that the payroll folks would have to determine and account for. Okay. Now we have two amounts that are very important, and I feel confident that most of you guys are probably familiar with these amounts. If you've ever received a paycheck, you're probably familiar with this. Gross pay is going to be the amount that you earn. Okay, in our previous example for Ryan, it was the $645 that he earned for completing work. However, he does not get to take home $645 because there are going to be lots of deductions from his pay. The amount that he actually gets to take home is going to be net pay. We also commonly call that take-home pay. And we're going to look at some common examples that account for the difference there. Okay, employers are going to have to make a variety of deductions when it comes to employee paychecks. Some of them are going to be required. Some of them are going to be optional. Okay, some of the most common required deductions are going to be federal income taxes and state level income taxes. Most states have a state level income tax. There are a few states that do not, but most of them do. And you'll even find a few areas where there may be some sort of local income tax. But any required income taxes are going to be withheld. Okay, FICA taxes, and there are two components to FICA that we'll talk about in just a second. There's a Social Security piece and a Medicare piece, but FICA must be withheld from the employee's paycheck. And then you've got other deductions that may be required. This might be things like garnishments or something like that that the employer would be legally required to include. And then you've also got optional deductions. These are the things that the employee may elect to have deducted from their check. This could be insurance premiums, maybe for medical insurance, dental insurance, life insurance, something like that. Contributions for retirement plans, like a 401k contribution. And then a charitable contribution. Some companies will have it set up so that you can make deductions that go to, the United Way or some other local charitable campaign. So let's look at the details for FICA. Again, I know most of you guys are familiar with FICA. It stands for the Federal Insurance Contributions Act. Primary components are Social Security tax and the Medicare tax. The Social Security tax piece is generally 6.2% of earnings up to a certain amount. And there is a cap on the Social Security wages that are taxed. And a lot of times students will have questions about that cap. So let me kind of briefly explain why that cap is in place. The way that the Social Security program works, employees contribute to the Social Security fund throughout their working years. And then when they retire, they are eligible to receive benefits based on the amounts that they contributed to the program. Because there is a cap on the benefits that participants can receive, they have to also align that cap with the earnings, okay, to make sure that people aren't putting in way more than they will ever be able to receive in benefits based on the benefit cap. So that's why we see a cap. It changes periodically for inflation. I would say it's normally adjusted annually. There may be a year or two, where it's not adjusted, but normally it's adjusted upwards annually. Medicare, there is no cap on Medicare. Medicare is 1.45%, and that will apply to all earnings. So there is no earnings cap on that. Okay, and here's just an example of what a payroll register looks like. And this will be used extensively by the folks working in payroll. If it's a big company, it's probably going to be your payroll department. If it's a small company, it could just be a bookkeeper. But this is going to be used extensively to determine not only the net pay for each employee, but also to determine the journal entries that need to be made from an accounting perspective. Okay, so here's an example of what a journal entry may look like related to payroll. Okay, the company would debit the wage or expense, the wage expense account for the total of the employee's earnings. Okay, then all of the deductions that were taken from the employee's paychecks would be credited to a payable account. The difference is going to represent the net pay that goes to employees, and that is the portion that goes in the salaries or wages payable account. Okay, now in addition to those withholdings that we have from the employees' paychecks, employers are also responsible for payroll taxes. This is something that not everyone knows. The employer also has a FICA piece, okay? We know that employees pay FICA, that's the Social Security and the Medicare tax, but guess what? The employer has to match that, okay? So your employer is also paying the same amount. So when you look on your paycheck and you see the amount that came out for FICA, guess what? Your employer had to match that as well. So they had to remit that amount to the government on their behalf as well. Okay, so that's a payroll tax expense for them because that's money that they're actually having to pay. In addition to that, employers are responsible for unemployment taxes. We've got FUTA and SUTA, as they're commonly called. That's the federal unemployment tax and the state unemployment tax. And that's something that the employer only will pay. Employees do not pay into the unemployment compensation programs. It is only the employers that pay into that. And the rates can vary depending on the company and what their employment records are. But normally it will be a certain percentage of pay up to a maximum level. Okay, and here is just an example showing how the calculations might be made for a given employee. Okay, and again, this is just an example. Some of these rates, especially FUTA and SUTA, may vary depending on the company because FUTA and SUTA are administered by the government. So if a company has for example, a poor employment record, meaning that they have a history of laying off employees, letting employees go, and that sort of thing, they may pay at a higher rate than a company that has a fairly good record. Okay. And again, here's an example of a cap, and this 118.5 here that we're seeing, this is from a few years ago. Again, it does change based on inflation, but it demonstrates that only a portion of an employee's earnings are going to be subject to the Social Security tax. Once you reach that cap, whatever the cap is for the year, any earnings beyond that are not subject to the 6.2% Social Security tax, simply because, again, they have that cap aligned with the cap on the maximum benefits that a person can receive. Medicare, again, entire earnings are subject to Medicare tax, and interestingly, this is something that's fairly new. There's actually a graduated scale. It used to be 1.45% on all earnings. Now it is 1.45% on the first 200,000. Then it becomes 2.35% for earnings in excess of the 200,000. Income taxes will vary. That's going to depend on the employee's tax withholdings and their income bracket, as well as their filing status. Okay, so here is an example of what an entry would look like when the employer is journalizing the payroll taxes. Now, again, remember, this is their tax expense, okay? So this is not what they withheld from their employees. This is what they are actually having to pay. So this is their portion of Social Security FICA, their portion of Medicare FICA, their portion, or, well, I guess the entire federal and state unemployment taxes, because all of those taxes are their portion, as the employees do not pay that. But this is kind of an example of what that looks like. The total goes to payroll tax expense, and then they do payables based on the parties that will receive those funds, the people that they owe the money to. Okay, now internal control. This is something that I know you learned about in your previous accounting course. Internal controls over financial reporting essentially help to ensure the integrity of the information that we're reporting. It helps to protect a company's assets and also to ensure that we are reporting accurately. Okay, some of the key components, generally speaking, for internal control are going to be the 5 elements of the COSO cube. That's going to be the control environment. That is going to be risk assessment. It's going to be the control activities. It's going to be information and communication and monitoring by management. So those are generally the things that we look for. Now, when it comes to payroll, I can tell you that payroll is highly susceptible to fraud. So it is very, very important that management implements solid internal controls over payroll. Okay, there are all sorts of things that can go wrong in the payroll process, and if good controls are not in place, it can be much, much too easy for some fraud to happen in this area. So management has to take care and make sure that they put solid controls in place. Now, so far we've talked primarily about liabilities where we know the amount. However, much of accounting is based on estimates, because the reality is we don't always know the exact amount of a liability at the time that we've incurred it. So we're going to look at just a few examples of situations where we have to estimate our liability. Okay, here's an example. In this case, we've got a company that uses a bonus plan that is based on annual net income. Okay, so the company has decided that they're going to use a formula to try to estimate this particular bonus amount so that they can go ahead and accrue it as the employees earn their pay and their bonus. Okay, so one thing that I'm going to point out here that I want you to notice with all of these estimated liabilities, the entry generally always looks the same. We're going to debit some sort of expense and we're going to credit some sort of payable. And the estimate is going to be based off the information they tell us. So I think sometimes when you initially see an estimated liability problem, it can be a little bit scary because you think, wow, there's a lot of stuff I don't know here. But here's what you have to remember. Remember, you're going to debit an expense, you're going to credit a payable, and the amount is going to be dependent on the information that they give you. So if you can kind of remember all three of those things, you'll be all set to record estimated liabilities. Okay, here's another example. Vacation benefits. Employees generally accrue vacation benefits as they work, so the companies also have to accrue those benefits. Again, debit an expense, credit a payable. Warranties. These are very, very common. Companies offer all sorts of product warranties. And the reality is they never exactly know what the cost of those warranties are going to be. For example, let's say that a company sells a product and they offer a 1 year limited warranty on certain parts. So when the customer owns that product, if certain parts break or fail to work within 1 year, the company is going to replace them. Well, at the time they make the sale, they don't necessarily know, what portion of these products are going to require, replacements or repair work, or whatever else may be included in the warranty. So for that reason, the company is going to have to make some estimates. And here is an example. So we're back on our Smart Touch Learning Company. They made some sales of $50,000. Cost of those goods was $35,000. They estimate warranty costs to be 3% of sales. And again, this is something that they would have to tell you in the problem. Most likely a company is going to make this estimate based on prior experience. If based on prior experience, they have to repair 3 out of every 100 products that they sell, they may say, okay, we'll just ballpark this at 3%. In this case, that's what the company's done. So we are going to accrue that warranty expense and warranty payable based on that 3% of sales. So we take the 3% of 50,000 and we're going to accrue 1,500 in warranty expense. Okay. Now we'll talk a minute about contingent liabilities. Contingencies occur when we have an existing liability based on something that happened in the past, and we may or may not have to pay this amount in the future, and we may or may not know exactly how much the liability is going to be. Okay, some really common examples include things like litigation, lawsuits. That's the most common place where you're going to see contingent liabilities. Now, for GAAP purposes, that's generally accepted accounting principle purposes, we are going to have to look at the likelihood, okay, the likelihood that we're going to have to pay, and we're going to have to classify it between remote, reasonably possible, and probable. Okay, and that distinction is going to determine how we report it from an accounting and financial reporting standpoint, okay? If the likelihood of us having to pay this liability is remote, we are not going to accrue it, and we are not going to disclose it in the financial statement footnotes, all right? If it is reasonably possible but not probable, if it's reasonably possible, then we are not going to accrue it, but we are going to disclose it in the financial statement footnotes. All right. Now we have probable, and this is going to be broken down into two possibilities. Okay. One is it's probable, but we have no idea what the amount's going to be. The amount cannot be reasonably estimated. If it's probable and the amount cannot be reasonably estimated, then again, we are just going to disclose it in the financial statement footnotes. And in most cases, we may even disclose a range. If we can kind of estimate a range of where that expense might fall, we could disclose that as well. If it is probable and the amount can be reasonably estimated, then we are going to accrue it and disclose it in the financial statement footnote. So accruing it means we are actually going to record that expense and liability on our books. We are going to record a journal entry and we are going to disclose it in the financial statement footnotes.